So now that you know how to execute trades, it's important that you know how to manage the trades that you've executed as well. There are two primary ways that I manage my trades. My favored way, and the way that I'm usually going to approach with, is stop loss trailing and scaling in. The other approach is taking partials. I'm not actually a fan of taking partials. I know people like to take partials, and a lot of people do that. I also know that people say you can never go broke taking profits, but actually I do think it puts a barrier in your way when you're trying to succeed long term. The reason being, when you take partials, you are cutting down the amount of profit that you can get. So let's say you have two areas like this that you're targeting on a buy, right? So you're buying from down here, you get in your position at this level, stops there, and you actually take some partials after it runs to 1R, which is a standard thing for people to do. And then you take more partials when the market hits your first target. And then by the time it hits the second target, you're only holding around a quarter of the movement. What this means is you've actually halved your move at this level, or quartered your move, and then you take another half of what's left on when you hit that secondary level, which is going to be just here. So by the time you actually get to, past this point, you're only holding half a trade, which means you can only make half the profit that you would make if you held the full move. And by the time you pass this point, you're only holding a quarter or a very, very small portion of the overall move. And what that actually means is, regardless of the fact you've completed your take profit, you barely made anything on the movement. The other issue with partials is you obviously never partial a loss. So you can take a full loss or, a cut profit. And that's why I don't like partials and why I like to work around them with stop loss trailing. Stop loss trailing allows you to hold the full move all the way to the target. I'll show you what it looks like. So let's say we had the same example there. We have this area to target, and let's say we have this area to target. We're buying in down here at the lows. We buy at this level. Our stops are here. Rather than taking partials at 1R, what we can do is go to break even. When the market comes and forms a new higher low and then a new higher high, we can then move our stops to this point. And we can just continue to do that. So when the market makes a new higher low and then breaks to make a new higher high, we can actually put our stops under the most recent higher low. And this is the method that I like to use because it allows us to take the full movement up and actually, lock in as much profit as possible on the movement. Then when we hit the first target, I still will not take partials, but what I will do is look to more aggressively manage the stop. So say we get a movement like this, I will then follow it. Or if we get in very low time frame ones, I'll also follow those. Because what we want to do now is ensure that we get a lot of the profit that we have on the movement. So even small ones we then manage. And the idea is if the trade hits the full target, which a lot of the times it will, we get a full large movement. So let's say we had a 5R move. Rather than finishing with 2.5 to 3R, like a partial trader would because they're chopping off most of their profits on the way, we can actually secure 5% or 5.5% on a 5.5R move. If the trade turns against us, however, let's say we fail to break this high and we sell off and we hit this point, rather than taking the full 5.5R, we actually get closed out of the whole movement at say plus 2.5R, which is going to be around what a partial trader makes when they hit the full target. But the idea is we want to hold the full move for as long as we possibly can. We don't need to be unnecessarily chopping bits of the trade off. We can allow it to either win and hit the full target or reverse on us and hit a trailed stop loss to close out a full risk move deep in profit. So let's look at an example now on a 5.2R winner. This is a partial trader and this is the scaling trader, the trailing stop trader. So the partial trader is going to buy in at this level. And when the market moves up, hits target 1, they're going to take a small amount of profit. They could take 0.25%, which is going to be 1R. Then when the trade hits 2.5R, they can take 0.625% profit, which is another quarter of the move. Then when the trade hits 3.5R, they get another 0.875% profit. And when the market comes all the way to their target, they get 1.3%. So over a 5.2R move, they lock in 3%, and that's the total. Whereas the trader who opts for scale-ins, which is what we like to do, or what I like to do personally, is get triggered into the move. And then as the market moves up, no partials are taken, but the stops are trailed. And when we hit the target, rather than getting 3%, we get 5.2%. So you can see we get almost double the profit of the partial trader simply by sitting back and allowing our trade to run. Now you may be asking, but what about when the trade doesn't work your way? What about when instead of moving up towards the target, the market rolls over? Well, when this happens, the partial trader gets to lock in a small profit. So let's say we get the 1R run, 0.25% profit locked in. We get the second run to 2.5R. And then before actually getting to the final move there, we sell off and the trade is closed out at break even. So the partial trader has now taken 0.875% overall. Now the trailing trader, which is what we want to do, is going to get the same initial movement when they get the 2.5R tap they will then trail their stops under there. And then if the market is to reverse, they're going to get triggered out. Now, what happens when they get triggered out? They get triggered out at a 2R profit, a 1.97R profit on the full movement, okay? And that is going to be a 1.97% winner, which, as you can see, is a lot larger than the 0.875% that the partial trader is going to be taking when his trade reverses on him all the way to break even. Now, you could argue that the partial trader would have also moved his stop under there, in which case he would have been closed out 0.5% of the move, so half of the move he had left at the 1.97R, let's call it, and that is going to be another around 0.9%. But we still make more by doing this than we do by doing this. Even though partial seems like a no-brainer because you get to take profits on the way, it cuts down your overall profit factor, and it also leaves you with less even when the trade reverses on you. So in most occasions, the best thing to do is actually to just let your trade run and opt for this trailing system because you're going to get better results from it. So now that I've showed you the difference between partials and trailing systems, I'm going to show them in action. Sometimes we do use partials, don't get me wrong. And you might think I've been hating on partial taking, but we do take partials sometimes. It is an important thing in certain occasions when the market is acting in certain ways. So I'm going to show you an example, first of all, when we trail, which is most of the time. And then I'm going to show you an example where we partial take and where we actually cut the move down on the way. After that, I'm going to talk about scaling into positions, which is also a very valuable factor to know when you are looking to maximize the profits out of your trades. So here we're going to look at a basic trailing example. We are on GBP/JPY and price just traded into a weekly supply zone. We had here a higher high, a higher low, a higher high, higher low, higher high, and then we swept through and made a lower low. Now this may be indicated as a little bit of a smaller time frame trade because if you were going for a real high time frame trade, you'd probably want to see a break of this. But for the intermediary time frames, 1 hour, 30 minute, 15 minute, and so on, there would be a nice solid execution from this supply point here. We have a break of structure. We then see momentum lacking, which shows us that the bears are entering the market. So what we can do here is place our entry on the midpoint. Obviously, I'm not saying don't use confirmation entries, but for these examples, I'm just showing the risk entry because we are really just focusing on the management side of it. But here we see the market then makes a run into the midpoint, and then we start our sell-off. So let's say for this trade, we were targeting, considerably lower prices. We are looking for a shift in the trend from a weekly supply zone. So let's look towards here just for now. This is going to be a very big trade at near 20R. And we see the market does sell off initially, gives us a nice rollover. And then we do get a break through the first structure point from our entry. So breaking through this first structure point, we can now go ahead and trail our stop loss to the previous high. So note what we said. We said we want to see a lower low form and then a lower high. So we've seen a lower low form now. And remember what we said, we want to see lower lows, then lower highs, and then lower lows. So if we get moved like this, we would then want to see this. And when we break that low, we can go ahead and trail the stop into profit. Because we formed a lower low, we can actually move our stop into break-even point. We could actually even move it to here, being logical about it, because this is obviously the area that then broke the structure. So by this point, your stop would either be at this level or at this level. And if we get a pullback and then a breakdown through that next low, we would then go ahead and shift our stops to the next level down. So here we've seen a big breakdown. We could actually then go ahead and move the stops to just above this level here or just above this level here. And then we can continue moving the trade down. And after that, we've actually seen then a push to the upside, which has taken out our trade at this level. Looking at this setup overall then, we have got a trade which has just closed out at 1 to 3. So thanks to our stop trailing system, we have now been closed out of this trade at 3R. But what we can do is continue running down. We saw the price did not come and fill all of that imbalance that we wanted to see. So we can continue on our way to our target. We have a 3R trade secured. And now what we can do is look for new reasons to enter. And if we get them, we can simply get back in. So we see here the market selling off. Well, we had this initial little break of structure, pushing us potentially down into a downtrend. If we could see a stronger sell-off, that would be good. We can see here, we just had quite a strong sell-off, which did indeed form a lower low on the higher time frame here. So what we could now do is look towards this area, which is the supply zone that broke structure, get our trade in there. Obviously, confirmation trades are also valid and also worthy. Stops above the zone, and we can then target down into that area that we want to trade into. So now we would approach the same way, and if the trade gets triggered in, we would simply ride it down and trail the stops as the trade tells us to. So here we are, we've been triggered into this movement. Now we can actually follow this low time frame structure. We see here, that's the next structure point. If we break that, we'll go break even. There we go. So now we can take the trade break even. And this is a good example of where we actually may take partials. When a trade is extremely impulsive, that is when we take partials. If we are getting a very strong market that's pushing down in one way and we cannot actually manage the stops very logically, then one of the best things we can do is actually take some of the movement off. And then that way, if it completes, we get a nice profit. But if it doesn't and it reverses quickly back on us, we've still locked something in. So you saw when we were moving down there, we had the slow sideways action where we could actually trail behind. So let's say we sell and we get movement like this. What this means we can do is actually trail the stop here, and then, if we get pullbacks again, we can then continue trailing the stop. And that is the ideal trading scenario, but that's not always going to be what we get. Sometimes we get triggered in, and then we get a very fast slam down like that. So we can go break even, but then where do we actually trail our stop? Now, we could just trail it randomly somewhere in there, but we may very well get a movement like this. So what we can actually do in the very impulsive instances, rather than trail the stops, we can just say, okay, let's say our target's here. We can take some profits here, and then we can let it do its thing. It may pull back, may stop us out, but it may also come back down and fulfill the target. So that's the second way that we approach trades, and not the most desirable way to approach trades, but definitely an effective way. If we have these slow impulses down, as shown, we can definitely trail behind that, and that's going to be what we like. But if instead we just get a very fast impulse down, we can go break even, take some partials on the way, and then let it run. If it turns back on us, we took the partials. Yes, we get a small profit, not a massive profit, but it allows us to hold the rest of the movement down if the trade does work out how we want it to. So let's have a look then in an example like this. We may want to take some partials now. Obviously, sometimes we can judge the low time frame price action. If we begin to see momentum die out like this, we could begin taking some partials. So let's say we take half of the move, and that is going to be a 4.2% profit. Well, 4.2R profit, which is going to be a 2.1% move. And from here, we can then just hold it break even and then let the trade do its thing. Could it turn out? Could it stop out? It doesn't matter because we will secure profits either way. So there we go. It looks like the target is going to be achieved in this instance. And as you can see, it was achieved for 7R. That is a 2.1% plus a 3.5%, and that is going to be a 5.6% profit on a 7R move. So as you can see, we don't miss out on a lot of the profits there. We actually do still get a very nice profit, even when the markets are very impulsive. So those are the two ways that I manage trades. Trailing is the most effective for me. It brings me the largest profits overall because it means that regardless of whether the market fulfills the target or not, I still get to take a full risk position. But partial taking should only happen when the market is very impulsive. Now, the benefit of actually following this rule, where we only want to partial take when the market's very impulsive, is that normally means the market has made a very large drive towards our targets. So say our target's here, by the time we're taking partials, we're pretty far in. So just like this GJ one we just looked at, where we ended up taking partials here, we're already around 4.2R out of a 7R move. So we're pretty much already there. Okay, we're 2/3 of the way there, and we take some of the path, and we take some of the profits, and then we see how the rest plays out. Obviously, this is not favorable, and sure, you could have just gone break even and held this out, but when we do have very impulsive market conditions like what we just saw, sometimes it's best to take a little bit of profit off the table because we do get rebounds, rebounds in the market where we get a big push down and then a big push back up. So that is the stop loss trailing process. Now, the other thing is the scale-ins. You can actually scale into movements as the market runs down, and I'm going to show you how to do that now. With the trailing system, not only can we trail stop losses, but we can also scale in positions. So we get into our first position, and then when the market gives us opportunities to, we can scale into secondary positions. Now, after teaching this method to a few students, I've actually seen a student collect a 16R scale in, which means the initial move was 5R, 5 times your risk, but they caught a scale in at 16R. Now, that's just one of many, but I think to date, that is the biggest one that I've seen. So the potential is there, and I'm sure that you will also master this skill if you actually just watch this video. If you watch this video deeply, make some notes, backtest it, and then of course, come over to me in the community and I'll help you put it into action. So GBP JPY, just to show an example here, we are on the 2-hour time frame, following on from what we were just talking about. The initial shorts from here, stopped out here in profit. The secondary shorts got on from this supply zone after we got a break of structure. So that's just something a little like this. We have that initial position on. But what we can do now is actually look to add to this position when the market tells us that that's a good thing to do. So the first thing we want to do is actually see a break of structure. We always want to see a break of structure to confirm a scale in because we need to make sure the trend is intact. So we would never scale in from this point if this low didn't break. Because what that tells us this actually could be is a lower low, lower high, but then a higher low and a higher high. So to scale in effectively, we always need to see the trend continue. What would signify that? A break of this low. So when we get a break of structure like this, we can begin identifying a potential place to put on some secondary shorts, okay? So what we've got here is this area in the highs, which was the zone that broke structure, and then there's also this area as well. But I would actually look towards this area because it's the zone that broke structure. I believe I've said that quite a few times already, but the zone that broke structure is often the one we want to focus on. So what I'm going to do here is go to the hourly time frame, just so we can get a more refined view of that supply area. Put the supply zone tool over that area there, the final candle before the impulse down, and also the zone that broke the structure. And what we could then do is go ahead and drop an order on this area. We're on the hourly, so we can go for the midpoint, and then we can stretch that out to our swing target. Now, just real quick, if we go back over to the 2 hour time frame, I'm just targeting this imbalanced demand zone. Okay, so this is an area that we could trade into, could potentially go further, but for example's sake, we will look at this one. Now that gives us a 22R potential winner here, which is absolutely huge, and potentially now another 13R position. I'm not saying you're always going to get massive risk reward. Trading isn't always like that. Sometimes your scale in could just be another, 5R on top of what you've got. Your initial position maybe 4R, 5R, 6R, 7R. But this is just an example, obviously best case scenario. And these trades are possible. I've taken some monster trades myself. Biggest trade I ever took was a 42R trade on gold. That's all on my Instagram if you want to check that out. And I've taken multiple trades of 10, 15R plus. There's also students who have obviously taken very high risk reward trades, like that one I just spoke about. And not too long ago, before filming this, someone caught a 1 to 12 over in the group very, very quickly in a matter of minutes. The possibility is there, but this is obviously best case. And this is high time frame trading. You may not actually get 22R out of a intraday trade, so to speak, because we don't have as much market movement. This is obviously going to take a lot of patience. I'm talking a straight week, which is obviously not a trading week. That's 7 days. So that's obviously not including weekends. So you'll be holding this for 7 trading days to get this profit if you did take this movement. But this is how we actually scale into it. So we use that refined 1 hour supply zone. We've dropped a new order on there. What we can also do now is look at trailing the stops. So we spoke about stop trailing, right? We've got our entry in now. We've formed a new lower low. So we can move our stop to over the previous lower high. Now what we can do there is line that up with the new trade. When we are scaling in, we never want to add risk to a position. What I mean by this is we need to make sure we are at least 1R into profit before we start scaling, which obviously we will be if we are waiting for structure breaks like this. Because that way, if we get stopped out and we lose 1R here, we are making, for example, on this position, we will be making 3R here or 2.7R, which means that if we lose on this position and we get stopped out, that shows us that the trend is broken here, but that gets us out with a total profit of 2.7R minus 1R, so 1.7R. So even in a losing scenario, we get 1.7% out of this move. Now, when you look at the fact that this move is currently running 10%, it doesn't seem so exciting. But if you repeat this over and over again and actually get into the systematic mindset of repeating the processes, overall, you're going to see some extremely big winners. For example, rather than a 22R win, which is already mind-blowing, you could potentially get, a 40R or a 35 here with another 13 dropped on. So leaving GBP JPY then to get triggered in, we see we get a little tap in there, and then a big sell-off to the downside. And what we can then do is take the profits on this movement and also the profits on this movement. Now, another example of this would have been earlier on when we got the initial entry and we were in from, for example, this area here. And we were running in some nice profits, okay? And then from this point, we actually saw a breakdown here and a supply area form and then another sell-off. So a good area for a scale in, for example, would have been somewhere in this area. I'm not going to scale in, I'm just giving you the overall idea, with an entry there and a stop there above the high, okay, above this previous high. As you can see, this trade would have been a losing one. So we would have lost 1% here. And on the flip side, we would have actually gained 1.64% on this move. So while we lose 1R, we win 1.64R, and that's going to bring us out above break even at around 0.65% profit. So that's what happened when a scale-in does not work, but when a scale-in does work, and you can pull a huge, huge move out of it like we just saw here, that is when they become very valuable. So to recap then, there are 2 different ways to manage trades with stop losses. We are either looking at the stop trailing system, where we enter a trade and then we trail our stop losses under the higher lows as the market moves, or in a selling opportunity, we scale out stops. Or in a selling opportunity, we trail our stops over the lower highs. The other option that we have is the partial taking. We opt to not partial take as much as we can, but sometimes when we get a fast impulsive move like this, it's going to be difficult to actually trail our stops, so we may opt to take some profits there. And then if the market comes up and fulfills our target, cool. If not, it's going to break us out at break even, and we're just going to have got, half the position at the majority of the profits up there. So that is the less favorable way to trade, but that is how we manage the very impulsive movements that don't give us much of a pullback. And then the scaling system can be used in conjunction with the trailing system. So like that GJ example that we just showed, let's say we have our initial entry in here. The market comes up, forms a lower high and a lower low. So we get that break of structure to continue the trend. We can then move the stop loss from this position to here, and we can execute a new short order from this position. Okay. So now we have a second sell on if the market comes in and triggers it, which there we go. We get the second sell on, and the stop loss is here for both positions. And the stop loss is now just above that for both positions. That means if the market does push through and take us out there, we are still locking in around 3R on the way down, for example, versus the 1R that we lose for a total profit of 2R. And on the instances which it doesn't lose, and we actually get triggered in and the trade runs nicely, we turn a 1R risk move into a 2R risk move, which essentially means we could turn a 5R trade into a 10R trade without adding any risk. That is how we manage trades in terms of stop loss trailing, partial taking, and trade scale-ins.